for coming to our Introduction to Investing in Income Real Estate. Today we're going to talk about how you can make higher rates of return with your investments and prepare for retirement. We're also going to talk about why right now might be the best time to invest in multifamily real estate in a long time. I'm Ben, and I also have with me today Earl Klein. And before we get started talking about why you should invest in real estate, a quick introduction on our team. Earl Klein does not need much of an introduction because his experience speaks for itself. Earl Klein has owned and managed close to 80,000 multifamily units and supervised the acquisition and renovation of over 3,000 units. In case you don't understand, that is a lot of experience. We've also got Roger Jacobson on our team, and Roger Jacobson has been a real estate agent, investor, and general contractor with over 20 years of experience. He's also developed self-storage units, multifamily units, and been involved in many flip projects such as buying properties, improving them, and selling them.
Hey, thanks, Ben. Ben, by the way, is one of our partners here. We love having him here. Ben got in contact with me a while ago and said, man, I really just want to work with you, and I really appreciate him reaching out. What you need to know about Ben is that he's a real estate broker or real estate agent, been involved in a lot of transactions. He's actually owned and managed a bunch of rental units himself. He's raised some money for his previous deals. And this one I love. Ben is currently earning a master's in real estate from the University of Utah. Now, if you know anything about me, you know I'm a big Ute alum, and so the fact that he chose my alma mater to further his education, I'm thrilled that just to be associated with him there. But the truth is, his goal is he's already decided what he wants to do, and it's real estate related through this process. The master's in real estate instead of getting an MBA or whatever. So this is a guy that really knows what he wants to do, and he brings a lot of skills and ability to our team. So. His sister Amber is, we're excited to have Amber also with us. Amber worked with Alliance Property Management. They're a big nationwide management company. She has also done an internship in marketing, which is one of the great things that she brings to our team is the ability to look at the presentations and say, I'm just going to add a little bit here and change this a little bit, and so we rely on Amber quite a bit for those. And she's also got a master's degree from Western Governors University here just last year. She finished up, so we're really excited to have Amber to our team. She brings a lot, including cooler heads sometimes when you get into some issues. She tends to just, hey, you guys just calm down a little bit, would you? Anyway, I'm just joking about that. Ben, go ahead and talk a little bit about financial freedom, if you would.
Thanks, Earl. Before we start talking about real estate investing specifically, let's talk about investing in general and what we're really trying to accomplish. Financial freedom is one of the goals that people try to accomplish with investing, and simply defined, financial freedom is when your assets produce enough cash to cover your monthly expenses. Now, this is also referred to as getting out of the rat race, a phrase that was originally termed by Robert Kiyosaki. Now, one of the things that our team is trying to help people accomplish is to become financially free and prepare for retirement. Now, something that I want you to be thinking about through this presentation is if you were financially free, how would that change your life? Obviously, it would change your life, but how it changes your life is up to you. So have that in the back of your mind. Now, let's also talk about how you get out of the rat race. There's really two ways you can do that. One is by lowering your monthly expenses, and the second is to increase your monthly passive income. Now, in today's presentation, we won't be spending any time talking about lowering your monthly expenses, but I want you to know that anyone on our team would be happy to talk with you at a later time to discuss how you can lower your monthly expenses. Our presentation today is going to be specifically focusing on what we can do to help you increase your monthly passive income. Now, this chart is talking about the difference between periodic income and passive income. Now let's talk about periodic income and what that looks like. An example of periodic income would be a job. Another example of periodic income would be flipping properties. You can make great money working a job. You can also make great money flipping properties, but it really is a job. It's something you have to continually do, and you get paid every once in a while. Now, what we're suggesting is if you were to take some of the earnings from your job or from flipping properties, and you were to put that money into a passive deal where you earn income, but you don't have to do any of the work, over time, if you were to continue doing that, at some point your passive income would surpass your monthly expenses. And that's just a thought process we are trying to educate people on so that they can eventually have enough passive income so that they can be financially free and retire. Now, this is a very specific example I want you to be thinking about. If you were to take $150,000 and you invest it at 8%, you should expect about $1,000 a month in income. And the question you really need to be thinking about is how much money do you need to invest in order to be financially free and get out of the rat race? So let's an example here. If you needed $5,000 a month, you would take $150,000, you multiply it by 5, and you'd get $750,000 you would need invested in order to get $5,000 a month in monthly income. Now, Earl's going to talk a little bit about more on retirement.
Yeah, thanks, Ben. So, when you're talking about preparing for retirement, figuring out how much you actually need is a big part of that equation, and that's why I love that example that Ben was talking about. Is that sometimes we think we're going to be able to do it with just a little savings here and there, but the truth is it takes a pretty sizable commitment, oftentimes, to be able to live off of the income that your assets produce, so that you can just completely quit working retirement. So one of the easiest ways, if you're going to prepare for retirement, this is really, really good advice, which is to start early. The earlier, the better. And I love this example. If you started when you were 20 years old, the question is, how much money would it take? How much monthly income did you have to put away so that you could end up with $1 million by the time you were 62 years old? And that, of course, assumes 10% return on your investment. The answer is $139 per month. That's not, at 20 years old, it's not that difficult. I remember when I was that age, I think I spent more than that at McDonald's. And so it would have been fairly easy for me to change my lifestyle a little bit and start to save. Unfortunately, most of us didn't. And so if you waited a little bit too long or a little bit longer, this shows you how much, let's say you start at age 30, how much would you have to invest at age 30? And it's now $371 a month. If you wait until you're age 40, it's over $1,000 a month, again, to hit that same $1 million by the time you're 62. And if you wait till you're 50 to get started, it's now $3,358, which is pretty substantial. You can see the earlier you get started, that time value of money really, really works to your advantage if you could start early. What if you waited until you were 40 and you can't afford to, you can only afford $140 a month or whatever? You can earn a little bit higher rate of return, and this shows you if you started at age 30 with the $140 a month, you'd need about 14% on your investments. If you wait till you're age 40 to get started, you're going to need to earn about 24%, again putting the $140 a month in. And if you wait till you're age 50, you need a whopping 54% return on your investments. And so the longer you wait to get started, the more money that you're going to have to put away, or the higher rates of return, or a combination of both of them. So this chart talks a little bit about average rates of return. You can see stocks. Typically, we talk about 10% on stocks. We look at real estate. REITs as a real estate investment trust at somewhere around 9%. Residential, commercial real estate somewhere between 9.5%, 10.5%. You can see if you invest your money in certificate of deposits and money market accounts, that those are going to be quite low. And then the other thing that's not listed here is real estate private offerings. and we're gonna try to talk a little bit about some of the rates of return that you might be able to get investing in some sort of a private offering. This one here, I love this example. It talks about real estate as the ideal investment, and it uses ideal to break out the ways that you earn money with a real estate investment. It's not like a bond where you just get interest every month. You're going to get the income. You're also going to get a tax advantage for investing in real estate. Equity is the portion of somebody paying down your mortgage. I love this concept with real estate, which is you buy an asset, you rent it out. The tenant pays your mortgage every month and delivers that property free and clear in 30 years or whenever your mortgage pays off. The last one is appreciation, which is the property going up in value. We're in a situation right now where we're going to probably expect a little higher appreciation going forward because the government's spending so much money they're spending more money than what they have. They're having to borrow that from the private sector. And then the last thing is leverage. That's really how much money you put into a real estate deal of your own money versus how much money you can borrow from the bank. All these things together mean that you're going to get rates of return from a lot of different areas when you invest in real estate, and that's one of the things that makes it so attractive as an investment. You're going to use an example. You buy a $100,000 home, you put $20,000 down, you get an 80% mortgage on it. The $20,000 that you put down on this, you should expect 7 to 10% return on your money. What we call cash on cash. Works out to be about $115 a month. We're gonna put all these together in a minute and illustrate a concept for you. Depreciation, again, you can depreciate about 80% of the $100,000. For residential, it's 27 and a half years. Gives you a tax deduction of about $2,900 per year, but it's not all tax savings. So the real tax savings, assuming that you pay 35% tax bracket, it's a little over $1,000 per year. Works out to be about $85 a month depreciation. Equity, again, it's the tenant paying your mortgage for you. Each month they pay that down. In the beginning of the mortgage, most of it, your payment goes to principal. In this case, $76 per month is going to be, most of it goes to interest, sorry, and the 76 is the principal portion of that payment. Over time, that principal gets bigger and bigger as you pay down more interest. Appreciation, we just use a flat 5% a year appreciation. Your property, next year it's worth an extra $5,000 with 5%. You divide that by 12, it's $416 a month. Okay. Leverage, again, is how much the bank puts up versus how much you put up. The higher the leverage, typically the higher rate of return that you're going to get on an investment. We're going to break this down for just a second. If you take $115 monthly income, you take $85 monthly depreciation, $76 of equity, and then $416 of appreciation. You look at those four numbers, and one of the things that that speaks to me is the fact that the appreciation number is almost 4 times what the income is. Okay, it's more than the other three combined, which tells me that when I buy real estate, everybody thinks you buy this to get rich on monthly income. The truth is the income pays for the property. You get wealthy by having that property go up in value over time. Your total return works out to be $692 a month. If you annualize that, times it by 12, it's $8,304 a year. If you take that $8,300 and you divide it by the $20,000 that you put down, this is your leverage factor, right? You're going to get about a 41.5% rate of return on your money. That's just astronomical. And the beauty of that kind of return is that I can have people put up the money. I'll find it, run it, take care of all of it. We'll split the rate of return. and you can still end up with 15 to 20% rate of return in your retirement accounts. So this one is also absolutely phenomenal. I love when we talk about real estate and the advantages. We know if we raise our rent, it's going to raise the value of the property, but $1 per month doesn't seem like a lot of additional rent, and you wonder if it's worth raising your rent that $1 per month. Well, if $1 per month is $12 of NOI, NOI is an annual number, and so $1 per month is $12 annually. If you take that NOI and you divide it by a cap rate or interest rate, it's going to give you the value. And so if I take that $12 per year, divide it by 0.08, which is an 8 cap, I end up with $150 of added value every single time I raise my rent $1 per month. And I used to talk about how cool that was, that $150. And then one day I sat down and said, what if I do it with a 6 cap, right? If I'm in a 6 cap market, well, it's now $200 of value add. And in a 5 cap market where we practice here in Salt Lake City, it's $240. You raise your rent $1 per month, you're going to get $240 back in additional value. Just astronomical. And that's one of the reasons why we love real estate, because you can push the value. You don't have to wait for it to go up. We can go in and push the values on these properties and make them go up. So we have a couple of strategies. Most people who invest in multifamily, they think you're buying properties and you're collecting cash flow. A lot of people don't think about the other side of it. So we have these two strategies. Number one is a cash flow strategy. Generally, you're looking for areas that have higher cap rates. We're still going to try to increase the rents through better management, tenant retention. Rent increases are small, $25 to $100 a month. Small renovations, typically $5,000 a unit. Carpet and paint is about what you're going to get with that. We're going to hold those for 3 to 5 years, and your return is going to include the cash flow, the appreciation, the tax advantages, and this is a long-term wealth builder, right? You're holding on to those properties. The other one is a value add strategy. You're typically looking for properties with lower cap rates, higher appreciating markets. You're focusing on properties that are undermanaged and needing significant renovation. We're going to raise our rent $200 to sometimes $500 a month per unit. We're going to spend a little more money, $10,000 or more. I've spent up to $25,000 a unit on some of the projects that I've done, which is a lot of money. In most cases, you're going to sell these quicker because of the tremendous value add. Your rate of return is going to go up the quicker that you get the money back to your investors. They're going to have very, very high rates of return, and this is going to increase your net worth faster. You're going to end up with money that you can then throw into cash flow type projects. And some people, they're financially set to start with cash flow from the beginning. A lot of people are going to probably want to start with some sort of a value project. So this is an example of a cash flow type project. This was down in Orange County, Santa Ana, California. And we basically we increased rents about $100 a month, mild renovations. We also reduced expenses by about $50 a month. This was by reducing vacancy, careful attention to what we were spending. We also purchased a trash compactor, which reduced quite a bit the cost of waste management. So this particular project, the monthly cash flow increased by about $73,000 a month. It's a big project, so obviously, but how would you like an extra $73,000 a month in your pocket, right? Cash on cash went from 12% to over 23%, which is just phenomenal. And because of the efficiencies, the operational efficiency of reducing the expenses, increasing the rent, we actually added about $11 million worth of value. Like to wake up with 11 million extra in your pocket someday, right? This one is a value add project. It's much smaller. A lot of times value add projects are smaller. They're easier to get in, get out, get paid, so to speak. This one, we bought this. Rents were about $600 a month. We raised them to over $1,000 a month, so $400 swing on the rents. It needed a lot of work. We put 150,000 improvements, which was 25,000 a unit on this one. You can see by the picture, we did a pretty nice unit with granite counters and new cabinets and the whole bit. The value went from what we paid 500,000 for to just a few dollars short of $1 million in 1 year. It was absolutely phenomenal. You can kind of illustrate the tremendous value of doing a value add project. So this one right here kind of illustrates it again. If you put $20,000 down on a $100,000 asset, if it's a cash flow type project, you're looking at 12% cash on cash, or maybe $100 a month. It's going to be $1,200 a year. It's going to take you 16 and a half years to get your $20,000 back, or to double that money. Where on a value add project, 5 to 10% appreciation a year, it's going to take you 2 to 4 years to double your money, right? You can sell the project, get your money back, and keep another 20,000 for yourself. So if you're just getting started, a lot of you are going to look to a value add project. So this is one of the things we do. I love to look at emerging markets, you know, when I'm looking for projects, because you're getting the benefit of the market. Instead of me doing all the work, the market's doing a good share of the work for me as it raises the value of my properties. So this is a map of the United States. It comes from the House Price Index report. It actually measures the appreciation rate of housing in each of these various states, and they're color coded. You can see the darkest one is Idaho. This one shows a 13.5% rate of return, or appreciation rate in the state of Idaho. When this map was produced, Nevada was 10, Utah's 8.5, 8.9. One of the things we look at with this is, generally, if I draw a line down the Rocky Mountains on the west and the Appalachian Mountains on the east, that the highest appreciation rates generally are going to be on the coastal side of those markets. It just if you graduated with a master's degree from Michigan and you had a choice of living in San Diego, California, or Cleveland, Ohio, I think most of us are going to probably opt for California. So it just shows that a lot of the jobs, that type of thing, are centered on coastal sites. Now, it's not consistent. In fact, right now you can see that there's almost a little bit of a reversal, and that the coastal sites have been the strong dominant markets for so long, and they've actually cooled off a little bit. Generally, the stuff in the middle of the country, the Midwest, they're slower to grow. Not always, but most of the time they're based on, the economies are more based on farming, and they build tractors and tractor tires and a lot of things like that. They're not as much high-tech markets as probably the coastal markets are. So one of the things that using that house price index report, the chart that they give me takes a 5-year average appreciation for a market. I'm going to take that and divide it by 5 so that it's an annualized number, which is what these right here are. Then you've got the 1-year number, which is kind of what's going on currently. And then I like to look at the quarter number. I take it and times it by 4, annualize it, so that I can compare those 3 numbers. And you can see what we get some interesting statistics. If you look at this one here, this is the state of Idaho, and you can see that the 5-year average is 12. The 1 year's 11.3, so it dropped a little bit. And the quarter number times 4 is 9.8. And so it looks like that market, even though it's an incredibly strong market, it looks like it might be slowing down just a little bit. This one here is Salt Lake City, where I practice. And again, the 5-year average is almost 10%, dropped to 7.7 for the 1 year number and 6.7 for the quarter number annualized. And that one's also looks like it's slowing down a little bit, although not as much as probably what Idaho is. If you down here, you've got the state of Mississippi. Their 5-year average is 3.2, very slow appreciation. The 1 year number is 4.5, and the quarter number. This is what I look at when I'm looking to try and predict the future, I guess, is that quarter number and see where that market's headed. Another one, Albuquerque. This is very definitely an emerging market, isn't it? You can see the trend upward. Lastly, if you look at Oklahoma City, you can see that this is a market that's been slow for a long time, and it's even getting slower. The reason that would be significant to me is that I would be looking at that as a market that I could keep my eye on, and probably when it flattens out a little bit, that we could probably go in and find some properties in there too. So a lot of different signals that you look for when you decide where you want to invest in real estate. This one right here is an interesting statistic. We monitor the median income of the market, and we monitor the median home price. This is how we determine whether a market's really affordable or not. As a general rule, an affordable market, the median income will be about 25% of the median home price. So $100,000 home price generates $25,000 a year median income. You can see from this that the median income average of Salt Lake is less than $50,000, which would justify somewhere about $180,000 to $200,000 median home price. Well, the median home price is over almost $400,000 in Salt Lake City. So it's not the most unaffordable market, but it's certainly housing prices have gone up much faster than income has over the last couple of years. And that could be concerning. It may benefit multifamily, by the way, but it's something that we just take a look at and try to monitor. Ben, take a second and explain this multifamily market cycle and how that correlates.
Well, thanks, Earl. When we're talking about investing in real estate, there really is a lot of things that you have to take into consideration. And that's one of the benefits of working with a team that specializes in buying multifamily properties, because we monitor the market on a regular basis so that we can make sure to buy properties that make the most sense financially. Now, real estate goes in cycles. And I'm sure you've heard that before. One of the things that we as a team do is we follow the cycles, and we have to make sure that we're following where each market or city is in its own cycle, so that we can make sure to buy properties at the right time and sell them at the right time to optimize our returns. Why is now the right time to buy multifamily properties? Well, first of all, the values have risen substantially, rents continue to go up, and both of those are being caused by a large demand for housing and also a very short supply of housing, which obviously helps our values. Now, there's also a shortage of affordable housing, which is important for the properties that we are focusing on, because the properties that we are purchasing are in the affordable housing range, which makes the demand for them even higher. Lenders are definitely willing to lend money on the right projects right now, which is why we are focusing on properties that are very desirable. And with the interest rates being low, it definitely helps our returns. We've also got student debt being very high right now, which makes renting a better option for a lot of people, which helps, again, our demand for the housing that we are purchasing. Multifamily is also one of the most stable commercial asset classes right now, because everybody needs a place to live. Now, one of the mistakes that a lot of people make when they start out in real estate investing is they say, I can do this on my own and I'll get better returns. I can tell you from experience that doesn't work out as well as you think it will. Commercial real estate, there's a lot involved to really have a successful project. This is just a list of a few of the people that are involved when you're doing a much larger project. And our team does a great job of communicating with all these people so that you don't have to do that and you still get the benefit of a higher return project. Now, our goal is to acquire 200 units over the next 36 months. And we're looking for people that want to be limited partners in our real estate projects. We're seeking another $500,000 to close on our next project. And we like to work on a first come, first served basis, obviously because we want to have a great relationship with our investors, but also because of the limitations we have because of SEC regulations. Our company has a minimum investment of $100,000 with each of our limited partners. We believe that we're uniquely qualified to find great deals in the best markets. We also have a lot of experience on our team to help our project be successful and ultimately to have you have a higher return on your investment. We really want to help you save for retirement and get closer to financial freedom. And the best part is that we do all the work and we split the profits with you so that you can still achieve a high rate of return, but do it passively. Now, we want to make sure that you qualify to work with our team. We've got our email listed here. If you haven't already done so, we want you to be able to fill out an investor profile, and you can request one of those at the email. We also would love to talk to you to get to know a little bit more about your investment goals. We've got a couple of appointments available. If you want to give any of our team members a call, we'd be happy to schedule with you. We've also have to put up our disclosure here. Our lawyer says this is required. The point is, when you're investing in real estate, there are risks involved, and we'll disclose more of those with each specific deal that we invest in. We want to put up on the screen here a couple of previous projects that team members have worked on so you can understand the experience level that we have. And we're really just grateful for the opportunity to talk with you about possibly investing in real estate. Earl, do you have any final thoughts?
Hey, well, yeah, first of all, thanks, Ben. Thanks, Amber, for putting the presentation together for us, and it looks beautiful. But we're just excited for the opportunity that we have to share something we love doing with you guys, and hopefully that in a way that will benefit you guys and get you closer to retirement and that financial freedom that we're all looking for. So enjoy the slides for a minute, and thanks very much for all of you coming and attending. Thanks.